Howdy, Jacob here. Today we're looking at Five Below in the specialty retail industry, 5.1 billion market cap, 4.8 billion enterprise value. They operate as a specialty value retailer in the US. They offer a range of accessories which include novelty socks, sunglasses, so many more things. Incorporated in 2002. So it's a pretty new company. The vibe I get from when I pass it and when I look at their financials is kind of a Dollar General, Dollar Tree, but it looks even better than those based on initial just high level review. So this should be interesting. Their revenue growth over the last 10 years was as high as 20% 5 to 10 years ago, but has dampened down to more modest, the 5 to 15% range, which is still very impressive. Gross margin, pretty flat. Operating margin, flat as well. I would like to see those becoming more efficient, meaning that they're reinvesting into stores that are getting massive margins and kind of either investing less or even devastations on locations that are not doing well. But they're still in the growth phase, so I'm not terribly concerned by those margins being relatively flat. Return on invested capital being declined and return on asset declining is something I'm also not super interested in. So it sounds like they're just looking to hit the top line, not as much the bottom line, which is not as something that does not attract me as much. Their um, balance sheet shows 180 million in cash and equivalents, 280 million in short-term investments, with 1.5 billion capital leases, no short-term debt, no long-term debt. So their only interest-bearing debt is going to be those capital leases, which again, for a retailer, not terribly surprised by that. Cash flow statement shows heavy reinvestment, which we can see by their capital expenditures going up over 10 times from 2015 to 2024. Their free cash flow is growing very heavily as well, which is great. But a lot of their money is being reinvested into likely new locations, is what I presume those capex to be. Um, but majority of that free cash flow, a little bit being reinvested, and then share repurchases is a good amount as well. So a lot of their money is going into growth, seeing a lot of these everywhere. So it makes sense. But again, it's going to get to a point where it's pretty much everywhere, like a Subway or something. And at that point, you want to lighten up the investments in um, those less healthy locations that aren't really doing a whole lot for you, and really pushing money towards those locations that are having fab margins. People are buying a lot, and buying, the big margin items, which I don't know if there's any big margin items in a uh, retail space, but um, even still, the second that volume cranks up, you can really make a lot of money hitting that bottom line. And so I think that's enough to get me to make some assumptions here. I would say that for revenue growth, they're really not in that many places right now. I mean, I have seen them a little bit around me. Um, I saw them quite a bit in my hometown of Minnesota, but I still think there's a good amount of room for growth. So let's say 8%, since a lot of their money is being reinvested through capital expenditures, which is very likely increasing property and plant, increasing locations and such. And then I'm hoping that margins stay relatively similar. The free cash flow margin is quite a bit lower, which I don't really like. But again, that's capex is increasing a lot, so that's similar to maybe a Amazon at the beginning where they weren't really making free cash flow because their capex was being, everything they were making was going back into the business, which can be very positive. So maybe I'll do 8 and 7%. A share change, 1% for them is about 50 million. Offset stock-based compensation about 70 million. Let's say it's relatively half that. Or let's say 1%, because at this point, maybe they're not reinvesting so much for growth. And so that's leaving a little bit more capital allocation available for share repurchases. And then, I mean, it is still retail. So maybe based on growth and return on invested capital, it may seem a little bit low to you, but that's just my perspective. And so I just think competition's high here. I think they're doing well, but again, these declining ROIC and making more money on top line than bottom line are things that I don't really like. So 16, I'm fine with as the PE, price to free cash flow, and it's saying it needs to fall 44% to get to the return we're looking for here. So hope you enjoy this video. Have a great rest of your day, and check you on the next one.